Most retirees build their plans around one prediction about the future. They pick a single market return, guess at inflation, and bet everything on being right. Here's the problem. When that prediction fails, the entire plan collapses. And I've watched it destroy 30 years of careful savings in just 12 months. This is a fan-made educational episode. Some narration may be AI generated and is not the real voice or statements of any individual. The typical retirement calculator asks you to input expected returns, expected inflation, and expected expenses. It spits out a neat projection showing your money lasting exactly until age 95. But what if returns are lower than expected? What if inflation spikes? What if healthcare costs explode? The calculator doesn't answer these questions because it can't see the future any better than you can. Today, I'm going to show you a different approach. Instead of gambling on one forecast, you're going to build a 3-scenario system that works no matter what happens. By the end of this video, you'll have a framework that protects you whether we see recession, recovery, or everything in between. This isn't about being pessimistic or optimistic. It's about being prepared. Most financial advisors will tell you to plan for 7% annual returns and 3% inflation. They hand you a chart showing your money growing in a straight line for 30 years. It looks reassuring. It feels scientific. But here's what they don't tell you. That straight line has never existed in real markets. Real markets move in cycles. They crash, they boom, they stagnate for years. The S&P 500 has lost 20% or more in 12 different years since 1970. It's gained 20% or more in 19 different years. The average almost never happens. And if your plan only works with average returns, it's not a plan, it's a hope. The hidden cost of single scenario planning isn't just poor returns, it's panic decisions at the worst possible moments. When your plan breaks down, you're forced to make critical decisions under stress. Should you sell stocks to preserve capital? Should you cut spending dramatically? Should you go back to work? These decisions made in crisis mode rarely work out well. When 2008 hit, retirees with single scenario plans faced a brutal choice: watch their portfolios collapse or sell everything at the bottom. Those who sold locked in permanent losses that took a decade to recover from. Those who held on often ran out of cash and had to return to work in their 70 seconds. Both groups made the same mistake. They built plans that required the future to cooperate. Here's the framework that changes everything. Instead of predicting one future, you're going to prepare for 3 realistic scenarios. For each scenario, you'll have exactly one action ready, no complex strategies, no analysis paralysis, just simple, pre-planned responses. Let me walk you through the 5 golden rules of scenario-based retirement planning. Rule 1. Define your 3 scenarios with specific triggers. Your base case scenario assumes slow growth with normal volatility. Market returns of 4% to 6% annually. Inflation stays between 2% and 4%. This covers about 60% of market environments. Your downside scenario triggers when we enter recession or see early portfolio drawdowns of 15% or more. Think 2008, 2020, or 2022 style corrections. This happens roughly 25% of the time. Your upside scenario activates during strong rallies when markets gain 15% or more in 12 months, often combined with easing inflation, like 2009 to 2011 or 2016 to 2017. This occurs about 15% of the time. The key is defining clear triggers. Don't guess whether we're in a scenario. Let the numbers decide. Rule 2. Assign exactly one action per scenario. In your base case, your action is systematic rebalancing. Stick to your target allocation, buy low, sell high automatically every 6 months. In your downside scenario, your action is defensive positioning. Reduce stock allocation by 10% to 20%. Increase cash reserves. Stop any aggressive Roth conversions. In your upside scenario, your action is strategic acceleration. Consider increasing stock allocation slightly. Accelerate Roth conversions while tax rates are favorable. Take some profits in overextended positions. One action per scenario. No more, no less. This prevents overthinking and ensures you actually execute. Rule 3. Set position limits that work in all scenarios. Never allocate more than 70% to stocks, even in your upside scenario. Never drop below 30% stocks, even in your downside scenario. Keep 6 to 18 months of expenses in cash across all scenarios. This range gives you flexibility without opportunity cost. During base case, maintain 6 months. During downside, move toward 18 months. During upside, you can operate closer to 6 months. These limits prevent extreme moves that feel right in the moment but destroy long-term wealth. Rule 4. Schedule your scenario reviews. Don't react to news. Review scenarios monthly, not daily. Ask, which scenario are we in based on the triggers? Has anything fundamental changed about your personal situation? Ignore weekly market moves. Ignore pundit predictions. Focus only on your predefined triggers and your personal cash flow needs. This scheduled approach prevents emotional decision-making and keeps you focused on what actually matters. Rule 5. Build flexibility into your withdrawal strategy. In base case scenarios, withdraw your planned 4% annually. In downside scenarios, reduce withdrawals by 10% to 15% if possible. Cut discretionary spending first. In upside scenarios, you can afford slight increases in withdrawals or accelerate major purchases you've been planning. The key word is flexibility. Your spending should adapt to market realities, not fight them. Now let me show you how this works in practice. Sarah is 68 with $800,000 in retirement savings. Her old advisor told her to expect 6% returns and plan on withdrawing $48,000 annually. When markets dropped in 2022, she panicked because her plan had no backup options. Instead of hoping for 6% returns, she built 3 scenarios with specific triggers and responses. Base case scenario, 4% to 6% returns, triggered when portfolio change is between -10% and +10% over 12 months. She maintains 60% stocks, 35% bonds, 5% cash, withdraws $32,000 annually. This covers her essential expenses comfortably. Downside scenario triggered by 15% portfolio decline or recession indicators like unemployment rising above 6%. She shifts to 45% stocks, 35% bonds, 20% cash. Reduces withdrawals to $28,000 by cutting travel and dining out. The higher cash position provides peace of mind and flexibility. Upside scenario triggered by 15% portfolio gains in 12 months or inflation falling below 2%. She increases to 65% stocks, 30% bonds, 5% cash. Can withdraw up to $35,000 and considers accelerating home improvements she's been planning. When 2022 hit and her portfolio dropped 18%, Sarah automatically moved to downside positioning. She reduced her stock exposure, built up cash, and cut discretionary spending. When markets recovered in 2023 and gained 20%, she shifted back to base case. No guessing, no emotion, no sleepless nights wondering if she was making the right choice. Just systematic responses based on predefined triggers. The result? Sarah's portfolio not only survived 2022's volatility, but positioned her to benefit from 2023's recovery. More importantly, she slept well through both periods because she had a plan for each scenario. Here are the 3 most common mistakes that destroy scenario-based plans. First, building a plan that only works if your forecast is right. Even with 3 scenarios, don't fall in love with one prediction. All 3 scenarios must be genuinely realistic. Second, adding too many actions and creating analysis paralysis. 1 action per scenario. Any more, and you won't execute when pressure hits. Third, changing scenarios weekly instead of sticking to your schedule. Market noise will always tempt you to switch scenarios. Stick to your monthly review schedule and predefined triggers. Here's your action checklist for building a 3-scenario retirement plan. First, write your 3 scenarios on 1 page with specific percentage triggers. Define what makes each scenario true. Base case, portfolio moves between -10% and +10% annually. Downside, portfolio drops 15% or recession indicators appear. Upside, portfolio gains 15% or economic conditions significantly improve. Second, assign 1 simple action to each scenario. Keep it actionable, not aspirational. Base case, rebalance every 6 months to target allocation. Downside, reduce stock allocation by 15% and increase cash reserves. Upside, consider slightly higher stock allocation and accelerate planned major expenses. Third, set your position limits that work across all scenarios. Maximum stock allocation, 70% even in upside scenarios. Minimum stock allocation, 30% even in downside scenarios. Cash range, 5% to 25% depending on current scenario. These limits prevent extreme moves that feel right emotionally but hurt financially. Fourth, establish your review schedule and stick to it religiously. Monthly scenario check. Which scenario are we in based on triggers? Quarterly detailed review. Any changes to personal situation or trigger thresholds? Annual comprehensive review. Are the scenarios still realistic? Fifth, define your withdrawal flexibility range for each scenario. Base case. Stick to your planned withdrawal rate. Downside. Reduce withdrawals by 10% to 20% if possible. Upside, allow increases up to 25% for planned major expenses or quality of life improvements. Sixth, decide what information you'll ignore. Create noise rules. No daily market checking, no reacting to financial media headlines, no adjusting scenarios based on predictions. Focus only on actual market performance and predefined triggers. Seventh, verify your plan with official sources like SSA.gov for Social Security planning aspects and consult with qualified professionals for implementation. To recap, single scenario planning fails because markets don't cooperate. The three-scenario system gives you predetermined responses to realistic market conditions. Your success depends on preparation, not prediction. This content is for educational purposes only and not financial advice. Always verify Social Security and retirement planning details with official sources.